Being conservative financially will really pay off when the rainy day comes. Many have said overestimates what will be done in 1 year and dramatically underestimates what will get done in 10. When I talk with investors, it's like talking to a schizophrenic audience. You have some investors that really want the slow growth, and then you have others that want the enterprise value returns.
Where are we now with where AI is? Is it Nokia 3310, the first iPhone?
This is when cell phones first came out. They almost looked like you were going to carry a little suitcase.
It's like Michael Douglas in Wall Street movie.
Exactly. That is where I think we are today.
Clark, you've been through some of the most dramatic moments in financial history, including Black Monday in 1987, when the markets collapsed in a single day. Take us back to that moment and tell me, what did you learn? What did you see? And how has that experience changed your way of thinking around cycles? How has that experience shaped the way you think about venture, private equity, and innovation today?
Yeah, I'll tell you, Firas, it's funny. There are certain events in history when you can actually remember exactly where you were standing, what you were doing, and maybe who you were with. That event, I actually can tell you exactly where I was, exactly what I was having for lunch, and who I was with. So I happened to be in school during that event up at MIT, and I was having lunch with a colleague of mine who he was working on his PhD in economics. And he actually was an avid trader, made a lot of money trading. And you may remember back then you had these little Quotron machines. The little antenna came up, and over RF they would give you the ticker tape. And wherever I went with him, he was just it's almost like today with people's cell phones. Back then it was a Quotruck sitting on the table while having lunch with him, and all of a sudden the market started going down. And I watched him, and then all of a sudden I watched him almost choke on his lunch, you know, as the sprouts went flying. And and then all of a sudden he's like, just give me a minute, give me a minute. And grabs his phone, because he carried cell phones were just coming out. They were there then, and he would carry one. And he on the phone he turned around and he called Fidelity. And he's going, I got to get my money out. I got to get my money out. And he said, I can't sell anything. I can't even get through. He goes, I got to go. Literally got up, ran out to get in his car. This was in Cambridge, to drive across the river to go to Fidelity to see if he could get his money out. That crash had a very personal experience, obviously, for a terrible lunch. Probably had even a bigger impact on him. What was interesting is I think back and I look at how many students didn't come back to the Sloan School, because so many of them invested their college loans and lost their college loans, so they didn't return to MIT for the next semester at Sloan School. But what was interesting at the time, I had a startup. The dreams, like every tech entrepreneur, to build a company, and we had the early idea, pre-internet, of the idea of social permission. And we thought that through social permission, you could really enhance marketing. And the early studies that we had done showed that social permission really can enhance quite a bit sales, especially of expensive items. And it's in essence what Facebook does today by giving people social permission to be able to go out and buy things. Think about the you're in a firm, you really want to buy the expensive sports car. You don't want to do it because of the family. You should be saving that money for the family. But the partner in the law firm or medical practice turns around and buys, the expensive Porsche, and then all of a sudden you had the social permission to go buy that. And we played off of that marketing data. Although back then we used more direct marketing type of techniques, but the impact was quite impressive as to what you could do with sales. We were going to compete against some really big players in the market, against ADP. And Reynolds and Reynolds at the time. And I'll tell you, going to do that next series raise, I watched venture capital pretty much go to zero. Almost no funding out there. Traveled all over, taking a lot of meetings with a lot of very famous venture capitalists. So I was certainly pleased that they were willing to spend the time with me to understand what we were doing and consider us for investment. But in the end, in talking with them, they were just like, we're not making really any venture investments, and that dried up for a good year or two. It turned out okay. I went to another startup at the time that isn't so much a startup these days. It's a pretty big company called Oracle. But I'll tell you, it was amazing how the capital markets dried up. And what that's taught me, especially whether it's private equity or venture or even a large corporation, having worked for Merck for so long, being conservative financially will really pay off when the rainy day comes. So many founders or even large companies, or even private equity firms today, they tend to run the finances a little bit too on the edge, and then when the rainy day comes, trouble happens. And when that trouble happens, you can be in a really hard spot. I see founders who wait to the last minute to raise. It's like watching basketball with a shot clock, right? Shot clock's running down, and they're literally just about out of money. And quite often, nothing comes through. In fact, it creates the risk around having someone finance the business because they look at it and they're like, well, you're almost out of cash. Even though it could be a great business, I don't know that I want to put money into it. So certainly the perceived risk of the business goes up when they do that. Whether it's large company, private equity, or venture, I'm amazed how often folks push the finances to the edge rather than being more conservative and worrying for the rainy day that's going to come.
So I guess what I take from what you just said is that experience, that moment in your career or your lifetime, it got you thinking about the importance of cash very early on and how you distribute that cash into your business, whether it's a venture business, whether it's private equity, whether it's a startup. But I guess the thing that I'm really keen to double click on is, and this is going to sound super amateur of me to even ask, but for the purpose of our listeners, why did Black Monday even happen?
Well, yeah. Well, perfect. I don't know if you ever took a look back at the derivatives market, but let's sell and resell things over and over and over again and create, just a calamity of risk on mortgages. So, and what's interesting, it not only told me the importance of finances, it also taught me the importance of spotting bubbles. It's funny when I look back, I've always worried about looking for the bubble in a go forward way. I would argue AI today is another bubble. Just about every hype goes through every hype cycle of a bubble. In retrospect, I actually wish I had invested on the downside of the bubbles I saw. Taking short positions actually, in retrospect, would have been a wonderfully financial rewarding move to have made. The real key was spotting the bubbles. And what's funny is, back then there were a bunch of indicators, that were readily apparent, and a lot of people saw the bubbles in the mortgage industry. And a number of people took bets on the downside, and they made billions of dollars because of it. So I think it's important to really spot the bubbles. It's funny because after that I went to go work I went to go work for Oracle, but then I went to work for Merck. And I joined Merck after 7 years of being, hailed as, the number one company to go work for and everything else. And what was interesting, just the rate of growth of the company, Wall Street was just enamored with the company, like it could never end. And I still remember I joined in the year that the CFO actually created a graph that said, in the current trajectory, I think it was either in 4 or 5 years out, the company would actually have more value than the GDP of the United States. So obviously it wasn't going to last. It was a trend that just couldn't continue at that growth rate. I think it's important to really pay attention and spot the bubbles versus looking for things that are really solid and have the solid underpinnings of growth.
Overspending and spotting the bubbles. You said that you feel that AI is, and this is an area that we'll touch on later, but since we've already brought it up, how do you distinguish between a bubble and a new evolution in the market? Is it still an evolution, but the phase that we're in right now is a bubble?
I think they're one and the same. Many have said famously overestimates what will be done in 1 year and dramatically underestimates what will get done in 10. I think that's just representative of the curve. So all these transformations, I think, start off with a lot of hype. I think the Gartner hype cycle is a perfect depiction of what actually goes on. And then eventually it settles into the reality and what can be done. I think AI is there today. I think it's still in the hype cycle. It's got another year to settle down. I think it would be unbelievably transformative to businesses, as several up and coming technologies will be like quantum. But the reality is it always goes through a hype cycle, settles in, and then the real transformation and where it's going to really have the impact will be seen,
Hmm.
and where the economics make sense. So I don't think AI is any different than any other technological change. Perhaps the one thing I do believe that's different is the impact of the technology on economics today is greater than in the past. So McKinsey actually has done a lot of great studies around this. You look at the overall impact to productivity of the steam engine. You're able to estimate what that multiplier is. Then you look at what the impact of IT was, for example. A lot of great work has been done around that. I do believe that the impact of AI, robotics, and quantum may even be a factor larger than the impacts in the past. So I do think we're in the hype cycle, but I do think the impacts will be unmistakable. It will transform all industries, as all technologies usually do. Otherwise, we'd all be telephone operators today or shoveling manure in the city, right? Because horses would be used in mass.
It's interesting the way I look at this, and definitely keen to get your thoughts on this. Is with every transformation in technology, the market expands, the opportunity to grow more wealth, whether it's a company or an individual, increases. For example, if you look at today's billionaires, yesterday's millionaire, tomorrow's trillionaires, today's billionaire, the market continues to grow. I think AI, from what I'm hearing from a number of people in venture like yourself, is the market's just going to be huge.
Completely agree. There's a lot of belief that jobs are going to go away. AI is going to
Mhm.
destroy all jobs. I think that's always been the perspective when a new transformative technology comes out. People equate for the job loss. When you actually look back in time, what's actually happened is more jobs have been created. I was early on when I was at in my career with Oracle. I was involved with one of the manufacturers of ATM machines. I think they're actually the largest manufacturer of ATM machines. And when ATM machines were coming out, I mean, there were almost protests in the banks, right? Because all the tellers were going to go away because now, we're going to have just automation. And if you look at what's actually happened in banking, there are far more tellers today than there were back then. This whole belief that jobs are going to be displaced, I think, is a wrong perspective. I think jobs are going to be certainly transformed. So there'll be a lot of new types of jobs that become available. My only concern is that when we look at the time horizon that these changes have happened, there was more time for the workforce to adapt to the change.
Mhm.
I think we may be approaching where the time by which the uptake of new technology and the transformation has to occur is happening so fast that the job change cycle is going to be a little bit caught in a quandary. And you see that in some respects in AI, right? When you look at the technology of AI, it's not magical. A lot of kids could have gone to school, for AI, and backing that up into the underpinnings of math, and so forth. And then there'd be a much more supply of talent on the market today. There's, I think, well, especially given what you do, you see the lack of talent in the space, and which is why you see pay packages for individuals with AI capability and AI experience. I mean, they're crazy. That will come down to as more supply enters the market of talent. So my only concern is that the transformation will happen probably faster than society is going to be able to absorb it, and that's going to create some real bumps in the road.
I definitely agree with you on the talent piece in terms of the shift in the market over the last 6, maybe 12 months, that push. But I mean, this technology is moving so fast. If you go on vacation for 2 weeks, you come back, it's changed. It's moving at such a fast rate. And in the talent space, I mean, just last week we closed our biggest placement fee in our company history. And when I say the biggest, I mean it's a number that I never thought I'd imagine would ever happen, purely because the compensation package that was offered was something that we had to even ask the client, "Are you? Can you just repeat that number again?" It was a profound number that I never imagined. But it's a reflection of the talent, the quality of the talent out there, but also I guess part of it is going back to the whole bubble and FOMO. if there's an element of hiring managers at the moment are keen to throw money at the problem because there's a race to AI. So let's bring in the best talent and move quick. As far as the current evolution of AI, if we compare it to mobile, right? Currently, our cell phone providers and if we talk about Apple, for example, an iPhone, I'm not sure if it's the 15 or 16 that's out right now. Let's call the current iPhone super intelligence. And I'm not even talking about AGI, just profound level of AI where it's teaching itself. Where are we now with where AI is? Is it Nokia 3310? Is it the first iPhone, in your opinion?
The picture I had in my mind, and this may predate you, this is when cell phones first came out, they almost looked like you were going to carry a little suitcase. So you're like carrying a little suitcase, it had the antenna that popped up, and it was on this big brick, and the phone would go on. That was the idea of a mobile phone. You remember with mobile computers, you had the compact computer, right? And so it was like carrying a big briefcase. Well, the next mobile thing was the cell phones.
It's like Michael
That
Douglas in the Wall Street movie.
Exactly. That is where I think we are today. The game hasn't even begun.
Wow.
We're still, sort of preseason experimenting. The game has yet to begin. I think the we haven't even entered the first inning yet, and I think that we're getting a glimpse of the impact of what AI. But I think it's broader than AI. I think it's AI, robotics, and then the reality is, unless we want to, do some acts of God to try to create more energy, we're going to need a better computational method. So I think quantum will come in. The demand for that, especially when it comes to AI, because the mathematical underpinning behind AI and quantum, there's a lot of common mathematical underpinning that you'll be able to power that from a quantum perspective. I think those three categories of technologies are going to be quite transformative, probably the most transformative out of any technological change that we've ever seen in history. And I think it's a good thing because if you think about demographics, especially on the robotic side, and well, actually, maybe all three. When you think about aging populations, first of all, I agree with Elon Musk on one thing, and that is, we need to start having more kids. Otherwise, we're not going to have a population to worry about. So it's pretty frightening the lack of the lack of population growth that we have. And if you look at demographics across the world, and then you look at the aging population that's happening, who's going to take care of everybody? Even if everyone starts having kids today, we're still going to have a huge gap. So you're going to need robotics in order to effectively care for an aging population, and also to fill the job gaps that are going to naturally occur. Thankfully, I think the technology is moving quickly enough that we have a real opportunity. I think for that to make an impact.
So Clark, let's unpack this. 1987 gave you a lot of big lessons around spotting the bubbles, thinking about how you reserve your cash, not getting excited. But then when evolutions happen, there's an element of, I don't want to miss out. How do I pick and choose what's going to be a good investment and what's not? And we can touch on that in a sec when we sort of think about your background in private equity and venture. But before we do that, I'm just wondering if where AI is now is as far as the mobile phones that are huge that you take out of a suitcase, then what happens when you have super intelligence? And I asked a couple of guests on the show before this question, if there's no way to stop it, if there's no fail safe button, what is the biggest risk and how do we even prepare ourselves for that risk?
I'm a little bit on the edge on the notion of super intelligence. I'm probably a little bit more, and I don't know if you've read the Apple papers on AI. If not, I highly recommend reading it as well as the Medium article, especially if you don't want a long technical read. The Medium article that summarizes it is even better. I'm not a big believer yet that we're going to enter this AI super intelligence, and we'll have this singularity moment. AI today is, I liken it to a huge pattern matching capability. Then the issue comes, you can certainly create new patterns going forward by introducing randomness and then learning on the recursive cycle of that. We'll see how well that goes, but will it actually create the level of innovation that humans have been able to create and will create going forward? I'm not that convinced yet, especially when you look at how just some of the innovations have occurred through history. I'm not 100% convinced yet that AI, it may eventually get there when you have, complete sensory feeding AI and you're able to spot, and then you have enough randomness mixed in.
Right.
You may be able to get there, but I think we're a long way off from that, Braz. It's not coming in 3 years. I mean, come on, you can't even, you know, you can't even get a Tesla to stop hitting something that runs out in front of it. For goodness sakes, it's like we're far off from super intelligence.
But let's say we get there, whether it's in 5 years or 10 years. And firstly, is there a possibility of that world? Even if it's,
I think I think the possibility exists. I do. I
yeah.
do. I think the level of computation that will be required for that world is not something that we have access to today. Then, and I when I say the level of computation, sure, Jensen Huang can go produce a gazillion chips. The problem is you need energy, right? And the kind of energy that you're going to need to drive that level, I don't think is there today. Now, enter quantum computing at scale. Yes, now all of a sudden that becomes a clear game changer in the equation. And being a guy who chairs the board of a quantum software company, I certainly hope that day comes. The reality is, right now, with current state of technology, it doesn't matter how big you build the data center. I don't know if you saw the latest overlay of Meta's data center. It's going to be Manhattan. Out in the middle of the country. I don't care how many of those you build. I don't think the current compute and energy curves support
Mm.
super intelligence in the way that I think most people envision super intelligence to be.
But let's say we got there, right?
Okay.
And we have a super intelligent, we've entered a time where the robots have been built and AI has just got to a level of super intelligence. You can't control it because it's not tied to a data center, or it's a robot. It has that level of intelligence. It can teach itself. It's all based on data ultimately, right? It can gather all the data and make sense of how to, as I said, improve itself. What is the biggest risk that we face as a humanity?
You create something that thinks for itself, has its own ideas and beliefs. We may not like, as a society, the outcome of that. It could be the end of society. Or we may watch a day when humans are enslaved by the machines. I think it could be real. I think, well, my suspect it won't be in my lifetime.
Mm.
Probably not even in my kids' lifetime, but in their kids' lifetimes, potentially.
And what happens if there is no way to stop it? Because it's a race right now. Everyone's trying to get to the point to win in this area, whether it's the big tech companies or the ones that are looking to own the application layer. Ultimately, it's a race. And if we get to that place, whether it's in our lifetime or not, is there going to be a way to stop it?
I'm a believer that evolution is inevitable. You can do all you want to try to stop it. You can try to put in as many government controls as you'd like to try to stop it. But the reality is, if it's on the evolutionary path, it will happen, sadly enough. So maybe Elon's right. Maybe we do need to have an outpost on Mars so that some of the human race survives what could be an inevitable end on this planet.
Taking us away from the grim ending, hopefully that's not the case. Let's go to the very beginning of your time at Oracle. Firstly, how big was the company? And tell me about that journey. What was it like seeing that company scale? And what were your biggest lessons at Oracle?
Oracle was an early public company. I joined in '89. Do you have a fact checker on the podcast? Quick, it'd be interesting to know what the revenue was in '89.
No.
I recall it was sub 100 billion.
584 million.
We closed at 584, right?
Yeah.
And the end of the year. So when I joined middle of the year, we were probably at about 250. We were growing at over 100% per year until we hit some little rocky times there. It was almost uncontrolled growth at that time. And that probably the thing that I learned from that is that growth can kill a company too, not just not growing. So when you get into hyperscale growth, there are a lot of decisions that need to be made right. There's less time to evolve when you're in hypergrowth mode. and you can end up making some mistakes that can kill the company pretty readily. We have seen startups that are blasting to the moon
Hmm.
that have gone as much as Series D, Series E, that are multi-billion dollar valuations that in essence crash. That was nearly Oracle, by the way. That was nearly Oracle. Thankfully, the company did some very innovative financing. I give Larry Ellison a lot of credit for that. Everyone watched a rabbit be pulled out of the hat, and the company was put on ground and continued to grow and grow well. But explosive growth can also be dangerous for a company.
Is this when a company is funded, or just generally, even when it's cash rich?
If a company's cash rich, as long as they keep their eye on quality, usually there's compromise on quality because it's hard to build the internal systems and processes needed to maintain that quality. Things can go sour depending on the market you're in. They can go sour. So I think even if you are cash rich, I advise one company today that is growing incredibly quickly. He's just passed his third year of operations from inception. I'm talking from here's my PowerPoint slide and third year of operations, past 65 million in ARR, and will be at 100 million in ARR by early next year. And I've watched the bumps in the road with regard to quality. They've actually had to slow down a little bit to fix quality systems, put in place processes so that they could speed up again. And, slow down to speed up, as the old saying goes. So I think explosive growth it can be dangerous for a company at any stage of the game, even when they are cash rich. Now, granted, if you're cash rich, you got much more of a cushion. But if things really go awry with customers, sometimes it's hard to get them back. So I think managing through explosive growth is just as important as managing through the tough times when a company is struggling, whether it be commercially or due to product issues or whatever have you. So I think both present a set of challenges. The leadership needs to keep their eye on very carefully.
So what you're saying is y- growth can kill a company because if if they're cash rich, revenue's there, but there is a lack of focus on the quality. What made them successful in the first place, their customers. Then, despite the money in the bank, the risk is it's hard to reestablish that confidence with your customers.
Absolutely. And if you lose customers, it can be very hard to get them, depending on the industry you're in, depending on the segment, it can be hard to get them back, if you ever get them back at all. So you can struggle, to return the market. And I
Mhm.
think that applies to all industries. Some industries, it's more permanent and lasting than others, but I think it's true for all industries.
What about the demand for your product or service, right? Let's say in tech with phenomenal products, customers are coming in faster than you can even manage. What do you do? Do you close your doors and say no, not yet?
I think to be successful, you do exactly that. And I can tell you a story. um, and this is when I was at Merck. I was also on the Sutter Hill Advisory Board, and Snowflake, which I had the opportunity to see as a very early company when Sutter Hill was considering really building that out. And the CEO at the time was Bob Bunglia, and Bob came from Microsoft. And I'd done the Microsoft guys very well because Merck was very dependent and utilized Microsoft technologies extensively. And when Snowflake came, I said, "Oh boy, this is going to be great. I need this technology at Merck." And he just looked at me and goes, "No, Clark, I'm sorry, we're not ready for you yet. You have too many regulations, and we're not able to meet the regulations." And he went after other industries that had much lower bars on the regulatory requirements and what he needed to do to meet them. 6 months would go by. I called Bob. Bob, I really need to leverage Snowflake. He'd be like, "No, no." And Bob literally put up his hand, probably
Wow.
for I, you know, I may have the timing wrong looking back, but it sure felt like 3 years before he finally said, "Okay, we're ready to sort of do early work in biopharma." And I look back at that, and I'm Snowflake's success is just undeniable, and I think part of that success was due to the rigorous discipline that they put around prioritizing what industries they went after matched to what they were able to deliver on against the kind of requirements. And biopharmaceuticals, they have a tremendous amount of, life sciences just has tremendous regulations that need to be met. And I think that was part of the success of Snowflake was being very methodical and very thoughtful about the industries they went after and how they sequenced them. And because of that, the company was great. And in fact, I really, my alternative at the time wasn't really much of an alternative. I ended up, building my own, so the company, I wouldn't be surprised if they are today. They were one of the largest contributors to the open source stack around Hadoop. And, we had huge engineering teams internally managing the data lakes. And, that was my alternative, continue to hire lots of engineers and build that out until eventually the commercial solution, would be available. But I look back at that and that discipline, which it's pretty hard to say no to customers. I mean, I'm pretty, I can be pretty persuasive and demanding. And I got no like clockwork every 6 months. So if Bob sees this, I spoke to him not too long ago. Bob, compliments to you for sort of saying no, not yet, many times.
That discipline is it's infectious and incredible, but at the same time, it's very difficult to say no, especially in the early days, right? Because the customer's there, it wants your product, and say no. There's a risk with that because ultimately they could go the other direction. There could be another product out there, and when you are ready, it's too late.
That risk certainly exists for us. I mean, it's undeniable, unquestionable. What was interesting was when Bob said no to me so many times, he actually built more credibility with me. Because if he was willing to say no to me, and biopharmas have quite large, technology investment budgets. And for him to say no, that was impressive. And that just made me think, okay, wow, okay, when this thing does become available, it's probably going to be much more capable to meet the regulatory requirements that I have. So he actually built credibility through that process.
So what you're saying is the risk of taking the customer on and potentially damaging the business and your reputation of that customer is far larger than the risk of saying no with the potential of losing that customer, because there's the credibility that you gain. And if you don't, when you are ready, if you don't end up getting the customer, ultimately you've won there versus taking on the customer too early and risking your business.
I think so. I think it's a very delicate balance.
Mm.
I do see some startups that honestly they'll chase every dollar, and I sort of scratch my head as to why they're doing that. It creates and then just an incredible amount of dysfunction within the organization, rather than knowing what their mission is, sticking to it day after day. Now, that's not to say that organizations shouldn't pivot, but when they do pivot, that pivot should be all in on the pivot. Versus, I've never believed that great businesses get built, through sort of a scattershot approach. I think that's a very dangerous way to build a business.
Clark, this feels like one of those episodes where we need to have a part two because I haven't even gone through all the topics we agreed on.
I'd certainly enjoy that, Faraz. Just let me know
Of course,
whenever you want to do that.
the next part of our conversation today is around that transition from the corporate world to the investment world. And you have quite a unique perspective on this because even until now, from what I understand, you're both in the private equity game as well as the venture capital ecosystem. So you're seeing both sides. And you and I have had many conversations about this over the years, the differences and how the two businesses operate. So firstly, what got you into private equity? Because I think that's where you started first before you tapped into venture. And secondly, what are the key differences between the two?
Yeah, yeah. Faraz, it's interesting. I actually went into both somewhat simultaneously. And I sort of chuckled that when I ended up deciding, because I was at Merck a long time, 24 years. When I got out, I said, you know what, I have no idea what I want to be when I grow up. So why don't I do everything? The only thing I didn't want to do, I know I didn't want to go back into a large Fortune 50 type of role, but I enjoyed. When folks ask me what do you do, I say, I enjoy companies you know, whether it's starting from PowerPoint or going all the way to where they're into, a multi-billion dollar revenue stream. I enjoy the entire spectrum. And the challenges across that entire spectrum are different. So recognizing that there's certainly a transition point in growth capital, but even most growth capital is still focused quite often on enterprise value creation. You eventually sort of tip over where the enterprise value proposition certainly is important, but it's centered more around EBITDA growth. And most private equity firms are more focused, on EBITDA growth, which, when you think about my skill set at Merck, whether it's all around the productivity equation, either thinking about how using technology, either to drive revenue, drive sales, or, quite often, which usually is more of the case, using technology to take cost out of the equation. So, but it's either side of the productivity equation, whether you're on the numerator or the denominator, driving revenue or taking cost out. That really is the equation that drives private equity and in driving EBITDA growth, which then gets you, obviously a greater exit multiple, assuming that you've executed the right growth strategies with the firm. Venture is very different in that it's much more of a play on enterprise value growth. In fact, I can tell you a great story. A private equity firm that I'm associated with, we had an LP meeting in New York that I was at. And the following day, there was one of the very large tier one VCs was having their LP meeting in the exact same location the following day. It was fun. I stayed for the LP meeting because I was an investor in the fund on the venture side. During the LP meeting on the private equity side, the presentation of companies, the thesis around companies, the discussion at the tables with LPs, there was one word that was common vocabulary, and that was EBITDA. Everything was, why was there an EBITDA dip? Why do we believe we can't get the EBITDA growth another percent? Why? I mean, it was, I always, and so sometimes I felt like I was at a monastery and everyone was walking around chanting EBITDA, EBITDA, EBITDA. The following day, I walk into the same room, right? It was funny, sitting down nearly almost at the same table I was at, listening to the presentations, and the discussion was all about enterprise value and enterprise value growth and the levers to drive enterprise value growth. The vocabulary, the thinking is just a little bit different between, I think, the venture versus private equity. The growth capital sort of sits in the middle, between the two, where certainly ensuring profitability and things are important, but it's not there will be folks who will trade off the level of profitability to get a much higher EV equation, and that's what really differentiates the two worlds. A lot of money that's in private equity. You've got a lot of institutional money in private equity, and the focus there is to produce the proper return, but to do that in a way that is not taking on too much risk. Which is why when you look at institutional portfolios, they've got it pretty carefully segmented into the risk categories that they actually place that money, because the venture community is taking far much more risk and betting on that enterprise value growth equation.
So EBITDA and enterprise value. First of all,
EV and EBITDA. Those are,
yes.
and may the two never meet in the same room.
Let's talk about the private equity side, right? So EBITDA is, explain this please explain it to our audience and viewers. What is it? How do you think about it, and why is it important?
Well, EBITDA is profitability. And if you think about the equation in private equity, there's certainly capital that goes into the equation, but then there's also debt that's applied to get a multiplier on the investment into the firm, into that company. So when you make that investment and you have interest rates, there are also, the banks are managing their risk. So there are going to be covenants around those loans. And the covenants around those loans are going to look at, what's the level of profitability? Do they believe that there's, increased risk? And you can trigger all sorts of covenants, which then put you at risk with the borrowing. And it really comes down to profitability. So any strategy that you're executing in the private equity world to strategically grow a company, you really have to think through the impact to profitability. That's a careful dance, pulling the right strategic levers to grow the firm, versus trying to maximize its overall value. That's a trade-off that venture is just, they're willing to take far more risk to maximize the enterprise value equation.
But the differences are quite large, right? I mean, in private equity, the returns are 3x, 5x, whereas a moonshot win in venture is, I mean, a snowflake. How many? Right. So when we think about that, when it comes to enterprise value, what exactly are venture capital firms mostly concerned about when they think about EV?
Venture capital firms, are pursuing a thesis that they believe you're going to have outsized growth of a market within a space, and because of that, you'll get an incredible value return. You'll create the next Snowflakes or Googles of the world, and then to get there, quite often time is of the essence. So you're willing to take far greater risk on the investment to fuel the growth to get to that destination. Um, but keep in mind, for us, it all goes back to who the investor base is. What did the investor base sign up for? When you look at what an investor in private equity signs up for, they're expecting a 3, 4, 5x return, maybe even as low as a 2x return, depending on the amount of capital being deployed. A 3x return in venture capital is interesting, but insufficient given the risk level. And I can liken this back even to investors in corporations. It's funny, in my career, I had the good fortune of working with all the greats in technology, and it was funny. I did quite a bit of work with Hewlett Packard, so I knew Meg Whitman pretty well. In fact, I was even on stage with Meg. And when she decided to break up HP, which happened to be right in the middle of me negotiating a deal with her, which created a very large deal, which created an interesting thing for me with my company on board. I asked her, I said, why are you doing that? And she said, Clark, when I talk with investors, it's like talking to a schizophrenic audience. You have some investors that really want the slow growth, and then you have others that want the enterprise value return. So by breaking HP into essentially the two businesses, you had one that gave you extremely the printer business, a very predictable growth, great return, for that level of risk. And then you have the enterprise side, which could then really pursue the enterprise value growth, higher risk, and so forth. And I talked to her after she had broken up the company, and I was like, well, how did the investor meetings go? And she goes, Clark, it's their sanity. Like, the same investors have the same discussions now in the room about the two halves of the company. Private equity and venture is no different. At the end of the day, it comes back to ensuring that you are aligned, very well aligned, with your limited partners. And if you're not aligned with your investors, that usually doesn't result in a good next fund.
Private equity wouldn't touch a very early stage startup, two founders with an idea and a pitch deck. No product, no revenue, never. Is it fair to argue that without venture capital, the Googles, the Facebooks, the Snowflakes of the world simply wouldn't exist?
Oh, 100%. I think that venture capital is it's absolutely critical. People are taking a higher level of risk and therefore deserve a higher level of return, for those investments. And I think you'll always have a market that's graded from risk return profile across the entire spectrum. So yeah, I think venture plays a very important role. Where I do see venture and private equity coming together, and we've seen a number of deals get created. There are a number of companies on the venture side that do well, but they never really, I think, achieve the hopes and dreams of what the founders had. And it's a perfect opportunity to take that technology company and merge it with a private equity company where, both sets of investors can take their money off the table, and then ultimately both can actually share in a real tech-enabled services play going forward. In fact, an early deal that was done in the private equity firm that I'm associated with, actually one of the companies I was on the board of was Cyax Health and a startup called Datavant, which did, in simple forms, tagging of medical records so that you could bring medical record data together. And those two companies were brought together. The new company is actually was renamed to the tech company Datavant, and that company has been pursuing that merge thesis, and the success is undeniable. Just, I mean, unbelievable success and growth. So I see there's a lot of opportunities for tech companies that maybe didn't achieve all the goals that they had hoped to. There's still much more runway available for them to creatively come together with sort of their private equity counterparts, companies, and bring those together in a tech services play that really delivers, I think, outsized performance, which then results in outsized returns to investors.
In terms of the value of private equity and venture capital, if we look at the focus areas are slightly different. One is thinking about EBITDA, and the other is thinking about EV. As far as a founder, let's start from the beginning. A founder comes to a venture capital firm and gets investment. What value does that VC firm offer?
I think it varies by firm, personally. Some firms take a sort of maybe what I call a lessons learned approach, where they add a lot of value in sort of bringing their knowledge of what works, what doesn't, and here are my experiences. Typically communicated at the board level. There are those firms that adopt a different model. Andreessen Horowitz comes to mind, and the model clearly has created success. When they first started that model early on, there was a lot of question in the Valley. Why do you? It's funny. It was almost taking a private equity approach to venture capital, where you're going to help them out, right? Private equity, we have many operating partners and operating partners that specialize in certain areas that, when needed, can insert themselves into the company. We think of them almost like special forces that can go in and make things happen for that company. Andreessen adopted that model. The number one thing, though, that I believe also, especially early stage startups, require, it's market access. They need as much access to markets and connections as possible. I liken it not only in terms of what I call customer acceleration, which obviously translates to revenue acceleration, which is very important to an early stage startup, but it's also being able to tap in to that network of relationships in order to get product market fit really fine tuned. When you can get product market fit fine tuned and you get access to sort of the relationships in a broad customer base, that is how I believe that you can really help bend the curve on success for a startup. And in fact, for us, as you know, that was the underlying thesis for the K2 fund, was to really focus just on that. How do we provide through events and other mechanisms that access to folks who would be buyers, whether or not they're buying, also just to give their guidance, their perspectives and feedback, so that they can get product market fit down. Because once you get product market fit down, it tends to take care of itself a little bit more.
Let's talk about K2. So we've been on this journey together, the K2 journey. I've learned so much working with you on this. For as far as our listeners and our viewers are concerned, let's talk about K2. What is K2? What is our thesis, and how do we add value to our investors? Sorry, to our LPs, but sorry, to our portfolio companies.
Yep. So the first fund thesis was actually, which predates you a little bit in joining the investment committee, actually to prove out whether the thesis would actually work. A, could you add value? And then if you could add value, could you translate that into being able to get into great deals? So that was the thesis. I also wanted to get a little bit of data around, even if you could add value and even if you could get into the deals, were you also able to see the deals worth getting into? So I was really curious to see that kind of data, which only time would tell. So we've been at the game coming up on you're going to be, I guess, starting year 6 soon. And the thesis was for broad horizontal capabilities, cyber, tech infrastructure, and AI, as well as some of the other technology layers, like broad horizontal, could we add value? And the reason why we went after those layers, we also believe that in those layers, you would tend to have exits faster and sooner than if you went after vertical capabilities. So we also saw the horizon of the fund being able to deliver results faster. I mean, that's proven out with one company in the portfolio. We did have one exit, a little over a year after investment that exited at 3x. Certainly not a multiple that I want for the fund. However, most people would love to invest all their money with a 1 year, a time horizon with a 3x return if they could. So, I'm not going to complain about it, but it's certainly not the overall return profile I would want for the fund. That being said, the thinking was, can we actually pull together using the events and other things where there's a history for startups that had gone through the what I call the event side of the equation, and amazing companies have gone through the event side of the equation. Box, Atlassian, Snowflake. I mean, I could name lots of these amazing companies that very early on went through the event side of the business, but it wasn't until over a decade later that we sort of coupled in the co-investment venture fund with it. So far, we've been able to get into amazing deals, quite often some of the hardest deals in the Valley to get into. Certainly many, because of direct feedback we get, if not most, of the companies that we've been involved with appreciate the involvement. I sort of chuckle. I like to say many investors invest to get a return on their money. We invest to do a lot of hard work because there's a lot of hard work in the go-to-market side of the equation, whether it's setting up events, doing dinners, creating annual events. I mean, there's a tremendous amount of work that goes into that. But so far, the results, both for the companies as well as for the fund, have been incredible. Very early raw data for us that we haven't presented yet at the fund, but I've been sort of mulling over the data since we started investing. First investment was at the beginning of 2021. And it's sort of evenly paced throughout the years. 15% of the companies that we look at that go through our annual event are now unicorns.
Wow.
It's an unfair statistic because the companies that went through last year really haven't had the ability to become unicorns. And I'd even argue the last 2 years. So I have a feeling that when we look back, 5 years from now, when we look back and say, let's look at the entire cohort of companies that went through Tech Day, how many became unicorns? I think the number is going to be between 20 and 25%. Okay. So when you look at investing, and these are all companies, occasionally they're Series C, most are Series B, Series A, and even seed. Occasionally we even have one or two that are still stealth, but there's a big VC behind them. I sort of think the analogy that comes to mind is shooting fish in a barrel. If 25% of the time I can place money and get a unicorn, I mean, those are great odds. The model, I think, works really well. And, looking forward to see, when we look back, 5 years from now, what that actual number turns out to be. But my gut tells me it's probably going to be about 20-25% of. I've got a statistician right now trying to predict it, but we'll find out what it is. But the hard number is a little over 15%. That's an actual based on subsequent raises and the value of those raises, not based on funny accounting. So that's based on companies that either exited or did a raise that was at unicorn status.
These are great stats. I'm keen to understand from you, when you look at private equity and venture capital, as far as the building a fund versus building a PE house, What's more difficult?
I actually think building a venture fund is much harder. And the reason why is on the PE side, there's certainly a lot of smarts that go into it in thinking through the strategy, understanding the sectors you're going to invest in, within those sectors, understanding the levers that you'll pull to get strategic growth of the company. But then I would actually say that private equity is equal hard work and equal smarts. I do believe that venture capital is probably 80% smarts and 20% hard work. Far more smarts and being able to look around the corner, I think exists in venture than it does in private equity. It's 50-50 private equity, 80-20 on the smarts versus hard work for venture. And also when you think about raising capital, people love the idea of. It's funny. I was talking to one individual. They're wealthy enough; they have their own private office, and we were talking about whether he venture invested or where he stood on private equity. And he said to me, he goes, Clark, the bulk of my money is in private equity, and in fact, it's actually also in real estate. And I asked him, I said, how much is in venture? And he said, we do 5 to 10% in venture to have it in the portfolio, not to miss out, but it's 5 to 10%. And I immediately, in my head, I'm going, okay, well, real estate's probably bringing you maybe 5 to 10% return. Private equities bring you 15 to 30% return. Okay, so what you're doing is you're haircutting those returns a little bit to dabble in the venture capital market. And when I asked him, why that allocation, and he looked at me and he goes, Clark, it's hard to make, that this kind of money. It's even harder to keep it. I looked at him, I said, okay, fair. Good point. Good point. So, you know, when you're wealthy, the goal is to stay wealthy.
Yeah.
It's great if you become even wealthier, but when you're wealthy, you want to stay wealthier. And I think that's why you see the diversification of the portfolio, way overweighted into those things that bring a healthy return, but not the venture returns. But I think even institutionals, have a slice that's in venture.
I'm guessing hitting your first 1 billion in net worth and then losing $1 could be quite painful.
Yeah, this is true. Well, it's funny. You say that it's funny. You think about it. Think about it, Frost. If you were worth $900 million, would it really bother you that you weren't quote unquote a billionaire? I don't think it would. However, Shark Tank and Robert Hershkovich, he's doing podcasts and stuff, and every podcast I've seen, he talks about how he moved to Australia, so now he's a billionaire because he wasn't quite. And I'm thinking like it's got to be like on the mind. So I think the idea, that I'm a billionaire minus a dollar, sort of like sort of hurts. You want to be at that $1 billion status, right?
Absolutely, yeah. It's a bracket that you want to be in. I want to go back to something that you might not remember you said to me a very long time ago. And this goes back to something you and I were discussing earlier on this podcast, which is you said never get over your skis, manage cash tightly, even when it's sunny, prepare for rain. I don't know if you remember
100%.
you. I
100%.
mean, why is that? I mean, because I wrote it down, and this was years ago that you said it to me. To me, it's important, and I live by this quote every single week when I run my P&L, when I look at my businesses and how to make sure I keep an eye on the cash. But explain to me why is that important to a founder?
So I'll tell you, Frost, I think it's not just because when we say founder, we tend to imply smaller companies. It's large companies too. Having been at Merck, Merck was at the time Judy Lewent was CFO, and she was, I think, one of the most conservative CFOs in corporate history. We always chuckled that around the company that Judy was saving for a rainy day. And guess what? The rainy day happened. Merck had an issue with one of the drugs, with Vioxx. The company voluntarily withdrew it from the market. You've got a drug that was over 2 billion, I believe it was over $2 billion in revenue at the time and growing. Any company in history that had done that failed. Merck recovered. Why? Because it was very conservative financially. And I think that's a perfect example of save for the rainy day. And whether you're a multi-billion-dollar public company or whether you're, a startup, keeping your eye on cash and always ensuring that you have a very nice long runway and taking quite often it's hard decisions to make sure that you have that really long runway is absolutely critical. I think founders and CEOs who don't do that quite often experience the rainy day. Then they get out over their skis, and before long they're headlong into the snow, and it's an unpleasant experience. That's always my advice, to founders and CEOs. I'm glad you wrote that down. I think it's absolutely critical learning.
I consider you as one of my mentors. I feel very lucky to have people in my network who I've worked with over the years who are way smarter than me and way richer than me that I can learn from. And that's one thing that you said to me. But as far as Runway is concerned, the bad, the good, the great. I know this might sound like a crazy question to ask, but what is a great runway to have?
You never let a runway go less than 6 months. You ideally want to never go less than 12 months. Well, it also depends on the stage of the company. You really want to have a 36-month runway on the company. Would be ideal. Earlier stage venture, you may end up with a shorter time frame than that. Just given folks want to see milestones before they're going to pile a lot more cash into it. But you really want to make sure that you're always planning for plan B. You never know what's going to go on in this world, right? There's wars all over the place. Interest rates are unpredictable. Pandemics can occur. And when these things happen, if you don't have enough runway, the reality is the plane may hit the end before it gets off the ground, and that's never a good thing. What's also interesting for us is if you think about it, folks who do early stage venture, you have to have a greater appetite for risk, right? Folks leave their jobs, they put stuff on the line, they go and they start a startup. You have to have a greater appetite for risk than folks that are working in a corporation. So your risk appetite is actually higher just by nature and by what you do. You have a greater propensity to run the company with less of a runway of cash. And what I would do is challenge those founders to say, you should really be thinking a little bit longer term. And there's nothing worse than also on a short runway to cash and you're trying to negotiate a deal and then you don't have the kind of leverage. Time is one of your key leverage points in a startup. And you run out of time, you've run out of leverage, and your deal terms are never going to be as good as if you had a nice long runway. And you can drag that out and have the opportunity to find other investors and so forth. So, time, I think time, which is fueled by the runway of cash on hand, is a very important equation that I think founders really need to think very thoughtfully about. It can be their best friend.
That's amazing. Thank you so much for that because this is a question I get asked quite a lot when I work with founders is what is a good runway? I mean, there's a lot of seed stage companies that we work with, as you know. But what about companies that are profitable? They have cash, they're making money, they're not whether they are in the private equity world or they're just businesses that make money. They're not reliant on venture capital backing. I know this whole show is inside Silicon Valley is about Silicon Valley, but for a business like mine, for example, where we're not private equity backed or VC backed, we have our own cash. What is a business like mine or businesses like these that are out there making money? What typically is a good runway? Is it 6 months? Is it 12 months? Or is it more?
Well, same thing for us. Minimally 6, but I believe you will really want to have 12 months cash on hand. Maybe as important or more important though is companies always look to put in lending facilities when they're in trouble. They never put them in place when times are great. And the funny part is lenders want to lend to you when times are great, and they really don't want to lend to you when times are bad. So the one thing I would say, especially for a profitable business, do you have your lines of credit in place? And if not, you should be running out and negotiating them and getting them in place so that you have something to fall back on. And I think that's super important. I can't begin to tell you how many business owners I talk to. When I ask them that question, they're like, no, I hadn't even thought about it. I'm like, well, you need to go think about it because, you have millions in the bank right now. Oh, interesting. Did you think about putting in a line of credit for a couple of $1 million? No, why would I do that? Well, because your bank account may not have millions in it in the future, and you may need that extra runway. It might save you. I think the message there is, while times are good, that's the time to be negotiating all of your lending facilities and getting them in place. And so that way they're there when and should you ever need them in the future.
I feel like that applies to anything, whether you're in sports or you're a musician. The time to bring your career to an end is when it's at its highest, when it's the time to think about, go for an IPO or raising your next round of funding, go at your highest, where the leverage is in your hand, as opposed to the shoes on the other side, and it probably doesn't look as good.
100%. 100%.
Clark, it really has been a pleasure having you on the show. And honestly, we haven't even covered half the stuff we agreed on, so we need to do this again. And
Yeah,
listen,
be happy to for us. Just let me know when.
Clark, one last question before I let you go. We have a tradition on the show, which is, so the show is called Inside Silicon Mind because it's all about learning and education for founders, investors, and people in business and engineers. Is there a book that you could recommend to our listeners and our viewers, one that has truly resonated with you throughout your career, whether you fall back on or not, but one that really stuck with you?
Especially for this space, early venture, that I think is required reading for all founders, and knowing the author, I think it's an important one. So folks should read, what have been is Ben Horowitz, the hard thing about hard things. I find so many founders find it difficult to make the hard decisions, and quite often when they're doing a startup, the startup is also, and it quite often has to do with people, right? There's lots of strategic decisions that need to be, but the hard decisions typically around people. And folks consider their startup quite often to be their extended family, and it makes it really hard to make the hard decisions. And I just think that's one book that should be required reading, and they need to go into it with the mindset that, they may have to make hard decisions. Matter of fact, not may, they will have to make hard decisions. Being in sort of the mindset that that's going to come, being prepared for that mentally, I think is really important. Having been at Oracle, the one thing, I have to say, out of all the founders out there, and having grown up at a time when, technology really exploded, and having, had the good fortune of having worked with or knowing many of the great tech founders in the world, compliment Larry Ellison, because at each stage of the game of Oracle, he would change out a leadership, change and pivot. He did whatever was necessary to grow to the next stage methodically. I think all founders need to think about that. Or they need to hand the reins to someone who it can and will make the hard decisions if they just aren't capable of or unwilling to do that. But yeah, that would be that's my recommendation. That's probably the one that in this space I think is probably the most important.
That's the one book that has been recommended the most on this show. So that's still a lot.
I'm not surprised. And having some of the commentary, having the good fortune of having met Ben Horowitz very early on, when they were actually pre A16Z. I think those words he lives by. So it's a great read. I would recommend it.
Thank you, Clark. Before we wrap up, I just want to remind the viewers and the listeners that quote, because it truly has resonated with me over the years, and it continues to. I have it written down in my office on the wall, so that's why I always remember it. So never get over your skis, manage cash tightly, even when it's sunny, prepare for the rain. I really appreciate that, Clark.
Thank you for us.
It really has been a pleasure to have you on the show.
Thanks much. You take care.
Thanks for tuning in to another episode of Inside the Silicon Mind. This podcast is powered by Harrison Clark. For more episodes, don't forget to subscribe and hit that notification bell. As always, stay curious, stay consistent, and stay inside the Silicon Mind.